Hi, everyone. Welcome to the Beverly Hills Bar Association program on Payroll Protection Program loans and loan forgiveness. Before we get started, I would like to give a shout out to our sponsor. A big thank you to the firm of Hochman, Salkin, Tasher, and Perez. Hochman, Salkin, Tasher, Perez has become one of the preeminent tax law firms in the United States by attracting highly respected, nationally, internationally recognized tax lawyers to their ranks. Before we get started, I would like to also introduce our speakers. So we have William K. Norman, who's a partner of the California tax law firm of Norman and Zach. Mr. Norman has been practicing tax law for over 40 years, including his experience as a tax manager of a national law firm, a tax staff member of a Big Four accounting firm, and a tax manager of a major corporation. In his practice, he focuses on counseling of clients in cross-border transactions, personal wealth transfer planning, and all the more. He has been for many years a lecturer or a senior adjunct professor in international tax and has been selected as Outstanding Teacher of the Year in Southern California. Michael R. Stein is principal of Hochman, Salkin, Tasher, Perez, specializing in controversies, including litigation and tax planning for individuals, businesses, and corporations. For almost 20 years, Michael has represented individuals with sensitive issues, civil tax examinations, where substantial issues may arise. He has had substantial experience in dealing with foreign account and asset compliance matters and other things. Stephen Hacht has practiced transactional business law for domestic and foreign clients since 1975. He has long-time experience with financing transactions, business formations and dissolutions, disputes among owners of business entities, buying and selling of private companies, and all the more. He regularly advises on business organization, financing strategies for LLCs. He's worked for private as well as publicly owned companies. And I'm LaVon Lawson, your moderator. I'm a tax attorney focusing on tax controversy and litigation, as well as compliance issues in federal tax, California state tax, and international reporting matters. Previously an attorney with IRS Chief Counsel's Office. I've worked with small and large firms, and I have my own practice. Before we get started, I would be remiss. There was a page there that talked about Beverly Hills Bar Association plans, and I missed it. So I just wanted to note now that over the Bar Association, we have some new membership plans. There's something for everyone. Take a look, see if there's something that interests you. If you have any interest, contact the Bar Association. So on to just kind of a little bit about the order of the program before I throw it over to Michael, who'll talk about the process, the loan, overview of the loan. So, in this program, we're covering a lot of information, and we will take Q&A along the way. But if we don't answer a question during the program, no worries. We will have time for Q&A at the end of the program, and we hope to have a lot of Q&A and conversation. We're going to cover overview of the Paycheck Protection Program application process. We'll provide detailed discussion regarding the loan forgiveness application process, including a case example. There will be discussion regarding very recent legislation just passed, so you hear about it first here, as well as proposed legislation. After discussion on disbursements, bookkeeping, and record keeping, there will be also discussion regarding audit enforcement, and of course, thorny issues surrounding tax issues, surrounding forgiveness, and other potential corporate and other issues surrounding forgiven loans, things to think about in the future. So there's a lot here. Just quick note, this is the Paycheck Protection Program. Is a U.S. Small Business Administration program out of the CARES Act, which included different various relief provisions to help employers keep payroll. Other provisions that were included the employer retention tax credit and the deferral of employer Social Security. But this program is about the Paycheck Protection Program. And in signing the HR 748, the CARES Act, the president noted that $350 billion was in job retention loans had been made available for small businesses and were forgivable where they kept on their employees. The first amount of funding was completely exhausted, and a second round of funding was provided. And Michael will be able to probably give us information regarding the status of loans, how much is out there, and what the average loan has been. You'll see through the program, there's a lot of legal authority you can find at the SBA website, and we will be going through various documents that are needed through the process as well. So with that, I'd like to turn it over to Michael to give us an overview of the PPP process.
Great. Thank you, Levon. That was a great introduction. Thank you, co-panelists. Good afternoon, everyone. So in the next 10, 15 minutes, I get to talk about an overview. What is the Program Protection Program loan? Who's eligible? What expenses can be used? I'll start talking about main issues that practitioners are grappling with PPP loans, the need standard, deductibility of expenses, loan forgiveness. If you could advance the slide, I'd appreciate that. Just as a little background, we're only talking about rules that have existed only for a few months. So back in March 13th, 2020, the president declared COVID pandemic warrants relief and emergency declaration. Congress acted March 27th. They passed the CARES Act. And the headliner, the important key component that we're talking about, is the PPP loan. The SBA administers the loan. It received funds for the loan, but it's not really a loan. It's intended to cover payroll for a certain amount of period, maybe 8-week period. Now it's been extended. We'll talk about that in a little bit. And then it was intended to be forgiven. The purpose of the loan was to help eligible small businesses grapple with the COVID-19 issues that exist in the workplace and in the public. And the intent was to act quickly. And with the haste and with the speed in which the legislation is enacted and the interim final rules have come out, there's probably 15 plus of those, there's complexity, there's inconsistency, there's uncertainty, there's confusion. And we're here today to try to unravel that, as many other people before us and will come after us to do so. So how is the program done so far? Well, as Levon mentioned, Congress authorized at the end of March $350 billion, and that was used up within the first 2 weeks. Then again, at the end of April, Congress authorized another $310 billion, and that was used up with respect to, not all of it, but $660 billion was allocated. As of yesterday, 4.5 million businesses have been approved for loans. Over $500 billion have been allocated. There's $100 billion, about a little less, available. 80% of the loans approximately are for loans under $100,000. And the average loan size was $113,000. The main attention now is directed to loan forgiveness. And a lot is riding on this because $600 billion of loans have been administered and much of that will be forgiven. The question is how, when, where. We're going to address that in a little bit. Interestingly, the main attention for loan forgiveness is heightened by the fact that 7% of the loans out there are already past the initial 8-week period to fund. And 23% of those loans will be by next week within 8 weeks, and then another 19% of those loans in 2 weeks. So there's current legislation that's pending that will need to be signed by the president that might help that, but there was a lot of pressure on the loan forgiveness part. So who can apply for the loan? Well, a business may not have more than 500 employees can apply. There's an exception for accommodations, food services, and drinking places with multiple locations. The eligibility is interesting and important. If you look at, I'm looking for my loan application, there are 2 forms that we're going to talk about that are SBA forms. One is 2483, referenced on the screen, which is the loan application form. And when you talk about eligible entities or people, you can just look at the form and it says sole proprietor, partnerships, C Corps, S Corps. Interestingly, charitable organizations, veterans organizations are there. Country clubs are not there. And so there was some discussion about that and why and how, but that's the loan application. There are some companies that are not eligible. California, the cannabis industry is a growing business. That's not going to be allowable under the PPP loan, for a PPP loan, because it's illegal under either federal, state, or local law. It's illegal under federal law for the time being. Businesses deriving 1/3 of their resources or revenue from legal gambling is not going to be allowed to apply for a loan. And then any companies that defaulted, or any companies that have owners with criminal activity, and they also threw in, for good measure, household employees. So for now, the funds will be available through June 30th. Like we said, there's maybe $90 billion left for people who need it, or until the funds run out. First come, first served. But what we're going to hear from Steve is that there's some changes to the rules that are coming that are impacting a lot of stuff that we're talking about. Certification is an important aspect, and it comes in the loan application process. It also comes in the loan forgiveness process. To apply for the loan, all companies or individuals need to certify as to they were in business on a particular date, the date specified is February 15th, 2, that they have need under the current economic uncertainty gives them need. And there's a lot to talk about later on as to FAQ 46 and how the need certification is going to be handled. I'll spend some time later on that. And then you can leave the slides right there. Use. People are going to need to certify that they're going to use it for the appropriate purpose. And that comes in the loan forgiveness application. For right now, on the loan forgiveness application that Bill's going to talk about probably in the next 5 minutes, I just want to highlight 2 important aspects. It's SBA Form 3508. It came out in May, probably 13th or 14th, thereabouts. And what is very significant about the application, in addition to everything that Bill's going to talk about it, is 2 aspects. One, there's a question, a one-liner, similar to what we're dealing with in other aspects of a form, but it says, did the borrower receive PPP loan in excess of $2 million? There's a very good reason why that's there. The reason is because there's a safe harbor that differentiates between greater than 2 million and less than 2 million. It's there because limited resources by the SBA, they need to know who's at 2 million and who's not. The need certification, safe harbor doesn't apply for large ones. And then the second thing to note is that there's a robust certification, again, that comes on in the loan forgiveness application that makes you basically recertify some of the things you previously certified to, and then also certify to the use of the funds. Now, turning to the slide, we know that the term of the loan for right now is going to be 2 years. Steve's going to talk about that's going to change. The interest rate is 1%. The loan fees are waived. What expenses can the loan proceeds be used? If you can go backwards 1 slide, it's used for payroll taxes, payroll costs, group health care benefits, rent under lease agreements that existed on that special date, February 15th, and utilities that you had obligations and services that existed before February 15th, 2020. Utilities include gas, electricity, water, transportation, telephone, maybe even internet as well. And so the next slide, and then I'll turn it over to Bill. What counts as payroll costs? Well, compensation to employees, tips, payments for leave, other things. And the next slide, please. What doesn't count for payroll? Compensation of individuals in excess of the annual salary prorated of $100,000. Certain qualified paid leave to the extent you get a credit. And most importantly, on this slide, compensation to any employee who lives outside the U.S. That's always been an important thing in legislation. They want to keep, I guess, jobs in the U.S. and apply the money for people who are living here. Payments to independent contractors also are not going to be allowed for payroll costs. And with that, we'll put it over to Bill, who will talk about loan forgiveness. And, oh, excuse me, I'm going to turn it to Steve to talk about the new legislation that just came out yesterday that passed the Senate. Thank you.
Thank you all. I'm Stephen Hecht, and it's a pleasure to be with you. I'm in the company of three particularly accomplished tax practitioners. I am not. I am a general business attorney with experience in a lot of fields, and I think we thought collectively there were a few things I might be able to point out that would be helpful to those who are more focused on the tax aspect, but should have a little bit of information about perhaps more general field. However, I'll begin by saying I have good news to bring you. It may not be breaking news because it occurred last night around 8 o'clock Eastern time. If you could advance the slide. And advance one more, please. And one more, please. Stop right there. And let me say that this good news began on May 28th when the House of Representatives, by a bipartisan vote of 417-1, passed what is referred to as the Paycheck Protection Program Flexibility Act of 2020. And it certainly is that. It provides additional flexibility to what Michael just described as the underlying initial loan. Next slide, please. The breaking news is that last night, the Senate, by unanimous consent, adopted the House law, the law passed by the House, H.R. 7010. Now, the significance of that is before that action by the Senate, there was a lot of concern that it would be bogged down because many senators wanted changes. They thought there were better ways to do it, and some of them, in fact, may have been. Nevertheless, there was a desire to move it ahead, and when the final objection was removed to some comments Senator Johnson had and concerns Senator Rubio had, joined by Senator Collins, the unanimous consent resolution was adopted last night. It was expected the president might sign as soon as today, and as of now, I don't know whether the president did or not, but I've been trying to follow it. More C-SPAN than I usually watch, but nevertheless, it brought this information. Next slide, please. So what did the new law do, and how is it going to help? Well, to begin with, it reduced the share of aid money that businesses are required to spend on payroll costs from 75% to 60%. That is very, very helpful because under the old law, there was sort of an assumption built into it that businesses were operating exactly as they had at sort of what was their equivalent of their particular full employment. Now there's more room to adjust things, and a greater amount of money can be spent on what Michael just showed us were costs other than payroll costs, but a big problem potentially. There may be a cliff built into this law, where under the old law at 75%, if one spent less than that on the payroll costs, then there would be a proportionate reduction in the potential forgiveness amount. Now it appears that the drafting of this law provides that the borrower must spend no less than 60% of the loan proceeds on payroll. And if the borrower spends 59.9%, the entire loan may not be forgiven. There's some dispute over whether that's correct or not, but Senator Rubio pushed the point, joined by Senator Collins, and it appears the parties have agreed to look to the Treasury and ultimately the SBA perhaps for a sort of issuance of rules and regulations and comments to get around this, or may have to go back and tweak the law. But that's the problem. Right now, you get the benefit, but you have to take, in a sense, the full benefit of the 60%. Quickly to finish up, there's been an extension of the time to use the funds from 8 weeks to 24 weeks. You have to choose one or the other periods. Now, the 8 weeks is running out for a lot of companies. 56 days has already passed since their funding was received. Nevertheless, they can choose to go into a 24-week period. And there will be a lot of modeling coming out and perhaps a lot of programs to help companies determine when they enter all their data, which is the best for them to choose and utilize. There's been a pushback from June 30 to December 31 to rehire workers, which can then figure into a 24-week calculation. Importantly, the extent of time to repay the loan has gone from 2 years to 5 years. In the original CARES Act legislation, the Treasury was given an opportunity to implement for up to 10 years for a loan repayment period. There's a lot of discussion to have 5 years. The Treasury chose 2 years, and it had 1 to 4% on the interest rate. It chose the 1% interest rate. Now, for new loans, as Michael described, out of what lending authority is left or might be added to, there's a 5-year period to repay. For loans that have already been extended, it looks as if the 2-year period applies. And I'll come back to a few comments on that at the end of the program when I speak again. And then for one final comment, companies are permitted to get loan forgiveness on their payroll taxes. Previously, the employer portion would not have been forgiven. It's deferred, but would not have been forgiven. Now it looks like it may be included in what is forgiven. Thanks.
All right, thank you, Steve. So I understand that we'll talk a little bit more about that later, and that's very helpful. I want to turn it over to Bill to talk about, to incorporate your recent comments or comments on the recent legislation into his forgiveness discussion.
Okay, thank you, Levon. Steve, I just had one copy of this bill that allegedly passed the House, which is in tax analyst. It has a provision that said there's no limitation on the non-payroll portion of the forgivable covered loan amount. I don't know.
That's true.
That would mean there would be no 60%. The way I'd look at it, you can spend any amount of as long as it's an eligible cost, you can spend any amount with respect to your loan proceeds. But anyway,
I think, Bill, you have an interpretation that may be contrary, but still correct to all other commentators who have looked at the law up to this point. But I think the general view is still that there is a requirement to spend the money on payroll, and that requirement is now 60%. And if one spends less, the entire forgiveness is at risk.
Yeah. And that's trying to carry out the purpose of the statute. Anyway, but maybe it's going to be an interpretation at some point in one of the questions and answers, or these interim final reports, if you will. Anyway,
I think the IFRs and the questions and answers will pour forth on this.
I did want to mention just briefly, and I don't want to go back to it, but on slides 3 to 7, we tried to list a fairly complete list of all of the what I call authorities, if you will, in interpreting this, what these rules are, ranging from the statute itself, and now if it's signed by the president, the amendments, to these interim final rules, which is kind of a strange term, which there are, I think, 15 of them. And then these frequently asked questions, which are in 2 pieces, which have 56 questions and answers, as well as very extensive instructions, and just the commentary, if you will, on it. If you want to count that, it's not really a legal authority, but it's sometimes useful. Anyway, with that, let me then go forward with the forgiveness amount calculation. We'll start here at slide 16, I guess. The next one, please.
Hey, Bill, I'm having a little difficulty hearing you.
Okay, maybe I go closer to it.
Thank you very much.
Okay, well, then we should go to slide 16. I don't know where we are here. Okay. Okay, here we go. It's up there. Here we go. Okay. What I've done here, and it actually goes back a slide before that, if you will, to slide 15. Just backtrack a couple. Okay, so now we're going here. All right, so this this loan forgiveness process is it's kind of the end of this whole thing here. If we don't have enforcement, which is I guess really the end of it all, and the statute of limitations running. It's got four components here that you have to fill out, plus something that's not here, but we'll discuss later, which is the documentation supporting what goes on these various forms, which becomes very important on the enforcement side, and just getting your loan and also getting the bank to accept your loan forgiveness application. So what you do have here is a loan forgiveness calculation form, which has very extensive instructions, which in the piece I've done here, I've really treated as if they're the rules, or implementation of the rules. Then there's some schedules that go with it to support numbers that go on the simple calculation form.
Sorry for interrupting. We have people requesting William speak louder or more clearly.
I don't know if I can speak any louder. I don't know what the mic will go up or not. And with that is a worksheet that supports a schedule, and then something which is not one of the forms is yet another kind of off the record kind of thing, but really is going to be part of your documentation. It supports what goes on the worksheet. It supports the schedule. It supports the calculation form. So I haven't given you everything here except in the instructions that you need to fill out and compute to do it. Then there's an optional form here which has some demographic information like who's getting a loan and information about the individual. This is optional. It doesn't have to be submitted, but it does give information about the kind of demographic variation of the loans that are actually being made. All right, let's go to, we'll skip the next kind of title page and go to the next one, this one here. Okay, so back. What I've done here is to put together in a kind of form of Lego blocks, if you will, or old-fashioned. We didn't have Legos when I grew up that much, as I recall, but we had blocks, certainly little wooden blocks, which I guess became plastic and then Lego blocks eventually. But anyway, I've used this as kind of a way of presenting what you need to do to figure out how much your forgiveness amount is. And leaving aside the legislation just for a moment, how it operates, there's basically three numbers that need to be either determined or computed. And then you take the lowest of those three numbers, and that's the amount of your forgiveness. And this is the first one, which is how much was dispersed under your PPP loan application. And we're assuming that the proper amount was dispersed. If it's not, then the number is, could be altered in kind of final review process, if you will. So Michael's gone over that. So this number doesn't change if it's a correct number. So let's go to the next slide. And here I put together the really difficult part, if you will, in terms of manipulation of numbers and computations, when computing these three numbers of which you take the lower of the three. And here you start with something we call eligible costs, and they have to be incurred during the covered period. And that's one of the pieces that would be changed by the legislation that passed both the houses of Congress. But currently, until the president signs this, I'm sure he will, it's going to be an 8-week period. It could be extended out to 24, or actually it's the earlier 24 weeks after the date the loan was originated, or December 31st of 2020. So the first thing is payroll costs, and we'll come back to that. Michael detailed a lot of that. Then mortgage interest cost, which is, these had to be, the obligation itself had to be incurred on or before 2/15/20. And then rental and lease payments, again, should say on or before February 15th, 2020. That's the agreement itself. That's not the payment. We'll come back to that later. And then utility payments where the services began before this date, 2/15/2020. And that's your eligible cost. That's the combination block of the four Lego blocks. And then from that, you subtract what we call a pecuniary reduction amount, or in plain English, a monetary amount, that is a reflection of the amount of reduced wages and salaries of employees that are making 100,000 or less during two periods, which we'll come to, and that amount then is a subtraction, and then you get a difference there, and then that's not the end of it. Then you have to multiply it by this time a ratio or a fraction, which represents the reduction in full-time employee equivalents over, again, some periods we'll talk about it shortly. And at the end, you get down to something I'm calling modified total of eligible costs. Some of the terminology I've just added myself to call it something, but it's really the total of eligible costs. So that's the second number. Let's go to the next one. And under current law, what you do here is you take the amount of eligible payroll costs, and the people over 100,000 have been thrown out of that. And depending on which way you like to do your math, you either divide it by 0.75, or you multiply by 1.25, or you look at it as 125% of this number. And that gives you a grossed up payroll cost. And then we'll come to the next slide. Move that along. And here's the forgiveness amount is the smallest of these three amounts, which are in the straight line brackets, which is the PPP loan amount, which we talked about, which is how much you borrowed, or really how much was dispersed, put it that way. The modified total of your eligible costs, which is what we just went through, taking all your eligible costs and then reducing it by the salary reduction amount, and then multiplying it by this fraction to get down to this modified total of eligible costs. And then the grossed up payroll costs, the eligible payroll costs. And you take the three of those, look at the smallest one, and then if you've gotten an FIDL advance amount, which is an emergency loan, we get up to the $10,000, then that gets subtracted out, so you don't get a kind of a double benefit. You don't get the $10,000 grant if you ever got it. I frankly never got mine, but and if you did, you subtract it, and that's your forgiveness amount. And then to the extent you've got a loan amount that's greater than what's forgiven, you've got excess funds, and we'll have to talk about what can you do about that, other than just paying it back. All right, so let's go forward. Can a bit more. Next slide. Okay, these are some basic definitions. They're come from the instructions, and I want to spend a lot of time on them, although the first one, the covered period, is one of these items that has been changed or would be changed by the legislation. So we currently have a 56-day period, the day of disbursement plus 55 days, which is a little confusing. It is a total of 56, but it's phrased, at least in the instructions, as 1 plus 55. Then there's an alternative covered period. And these are for people whose payroll periods don't match up with the particular 8-week period that we're talking about. So they have a payroll that's paid, let's say, shortly after the loan disbursement date. And that payroll covers not only what the payroll for the period for the loan disbursement date to the date the the payroll date comes up, but the period before. And then at the end of the 8-week period, you're going to have a payroll period that doesn't match up. It's going to be before the 8-week period, 56-day period has expired, and you get to accrue. So you have, for accountants anyway, you have a strange situation where you have a kind of a cash method where you're picking up more payroll payment that's greater than the amount of payroll that's actually been earned or accrued, if you will, since the date of the application or the funding. And you have at the other end, you get to accrue what you haven't paid yet. And it's kind of a mixed method, but that's what the instructions clearly permit. So
Bill, so Bill, I have a question for you. So then doesn't the alternative payroll covered period provide a benefit to the small employer by allowing them to boost up the payroll?
It depends on when the payment period is the date of the disbursement, then you're picking up, all that payroll from the before that. But at the end, you're going to have presumably an accrual. So it may, depending on how the calendar works exactly in the 29 days in February, which you have, how it all works out. It could be a benefit, but I found it basically comes out the same if you just accrued it the whole period or you did this kind of mixed method. It's more for accounting convenience. So I'm not sure there's too much planning, but you may want to look at both methods when you're coming up with your period. Although now we've got 24 weeks, so it made this planning here may be not that significant. But it's a good question. Let's go to the next one, please. And this is the cash compensation we've already Michael's talked about. So I'm going to just pass on that. Probably people have some questions on that as to what is in here, but you do include kind of it's gross wages, so you don't have deductions for the employees' FICA and their withholding. At least that's the way the instructions put it together. The statute is a little confusing, and there is a footnote. I think it's the question. I think Q40, which tries to explain how the SBA came up with their interpretation. Let's go to the next one here. Only thing to mention here is more about non-cash contributions, which count as well. In my example, which I have at the end, which you won't have time to go through in detail, be sure to add those back. Now, for owners, if the owner is an employee, they're going to count as having a salary or this non-cash compensation. So even employees of S corporations, which we generally try to drive down as much as possible. But here, to the extent you've driven it down below $100,000, you've kind of hurt yourself in this computation. But owner would be allowed up to $100,000 on an annualized basis. If you have a partnership, for instance, then it's that self-employment income counts, and the partner, if it's an active partner, would then be part of the employee census, if you will, and it should be a part of the original loan. If it wasn't, for instance, in my case, the bank wouldn't allow, or the bank council wouldn't allow me to put the partners on the partnership application. And then about 10 days later, there was on April 11th, another of these interim final rules. I think they're in them because they're going to come out as final regulation, which will go into the Code of Federal Regulation. So that's why they're designated that way. They said you could, self-employed partners could qualify, active partners could qualify, but they should be part of the loan application of the partnership, or the LLC if you have an LLC. But you had to add this increase before the bank provided a certain report. It's the 1402 report to the SBA, which they're required to do so many days after the date they fund the loan. So in my case, I don't know if whatever happened. I applied for the increase. I haven't seen the money in the account. I think the days have passed. I think it was May 22nd or something was the day that the this report from my bank was supposed to go to the SBA. So I guess I'm not going to get the increase unless they change the rules, so that you can increase even though your lender has already made a report to the SBA. Okay, let's go to the next one.
Hey, Bill, I'm getting a question about self-employed. It says self-employed is a huge issue. Are they limited to $15,385? It says self-employment is a huge issue. Are they limited to $15,385 or no?
Oh, okay, yes. And but that's going to change. I mean, so.
I guess they're looking for clarification regarding self-employment. But
That's coming out. Okay. We move back one where we have it mentioned here. We go reverse. Go back one slide. What the point is, if you took 15, whatever it shows up here, but yeah, there. This is done on the covered using the covered period. So you have to divide that by 52 and then multiply it by 8. Now, I don't know what's happening here with the 24 weeks. This is going to be you can multiply the number by 24 and not 8 after you divide by 52. So it's going to be 3 times as big. So I guess it'll be 45,000.
Yeah. Bill, can I jump in there for a second? I think self-employed individuals is a huge issue. I think, first of all, the $15,385, if you're self-employed, the question I've seen is whether you have to pay it out or pay it in some other fashion. I think the answer, as long as it's on your Schedule C, you get that as the forgiven portion. There is an open issue as the new regulation or the new law is going to change the amount that people are entitled to apply for the loan. And then there was a question I saw that, hey, if I've already submitted my application, can I resubmit and get a larger amount under some of these new rules? For what I've seen in the interim regulations, I don't think you get a second bite of the apple to reapply. And so for those people that haven't applied yet, I think you're going to have an opportunity to maybe assess the new rules. But certainly with respect to self-employed income, self-employed people, sole proprietors, there's a lot of confusion as to what qualifies, what doesn't. I think the point there is you don't necessarily have to pay it out as salary. There's an employee owner, sole proprietor share. And then 2, certain benefits, such as health benefits and other benefits, such as retirements, probably aren't treated in the same way they would if they were paid to non-sole proprietor people. So with that, I'll turn it back to you, Bill.
Right. Yeah, I mean, with the self-employment act, you have a situation where you don't make any money because of the various factors that are going. Your shop's been trashed, or you can't go back to work, or you can't operate at a capacity that allows you to make a profit. So you can have a problem in that respect. All right, let's go on here. We're at slide number we're at here. I think we're at slide 27. And the slides here from 27 to 30, which I'm not going to go in detail, but people have questions on them, and they could have questions on them. Are these non-payroll costs? And there's some record keeping or documentation aspects of these. If you're talking about loans, you want to be sure you've kept, even if you paid something off, you've kept for 6 years. The documentation shows you actually do have a loan that was in place before the magic date. And it's not just for real property. If you own your business facility, it also includes personal property. So if you're renting office equipment, that kind of thing, that would count as well. Let's go to the next one. Lease payment. Some questions I get in this is that the lease payment may include, includes things like parking, but also may include utilities or phone charge if you're operating in a kind of a suite situation or a WeWork situation. And the way I read this, your documentation, you got to break it out. I think parking is part of rent, but anything that's a utility charge or anything about the telephone or internet, that kind of thing would be a separate item. Let's go to the next slide quickly. Again here. This is the utility. Really obvious stuff in here. I guess the one question is that people have asked about is, what is transportation? I suppose it could be reimbursed transportation to employees, that kind of thing. Or if you own your own delivery truck, it's not clear what that is, and is it, is it depreciation of it, or if you're leasing it, you'd have a payment, but if you own it, could you take the depreciation? So and that particular item is not expanded in any way. So let's go to the next one. And this slide 31, we're beginning really with just a calculation of this maximum loan amount. And I'm not going to, I don't really have time to go through all of these things in detail, but what we're doing, and it's really slides 32 to really to 39, and then maybe just skip to 39, and wait, actually the 40, is to compute this full-time employee equivalent. And it's based on a 40-hour week. And you will come if your salaried people are not required to work 40, or if you have hourly people who are not working 40 in 2 periods of your covered period, which now has changed, and a period that's it's actually in the statute and in the regulations. The difference between those 2 periods, you're going to reference period and your covered period. You end up with a different full-time employee equivalent. We produce a ratio, and you put what it is in your covered period, which now is longer. It could be shorter. There's actually an election. We can make it shorter. You can make the 8 weeks back if you want. And the denominator is the full-time employee count during the reference period. And you'll get a ratio, which is the next slide, which is what it tells you, which is easier to see in an example. So that is that reduction in the it's due to because the fact you've reduced your head count. I'm not going to go through the safe harbors. Let's now look at let's move to another calculation here, which is the salary hourly reduction, hourly wage reduction.
So Bill, I think we're running short of time, so it's about 3:52. So if we could focus where you want to, I don't know if you want to do the example or
to mention this, and then we'll get this. As the salary hourly reduction is where you're comparing employees that make $100,000 or less, again between 2 reference periods, and if there's a reduction, then that reduction is a monetary amount, and it reduces then that those blocks will be lined up. There is in the interim final rule that was issued in May 22nd of this year, they said that the rule said that if you have a reduction in your salary because of a reduction in hours, you don't double up. You don't have kind of a double count. You don't get reduced because you reduce the number of full-time equivalent employees. And then also because you have now a reduction in salary. So you have to adjust back to the fact that part of the salary reduction is due to the fact the hours went down. So after you get that done, then you've ended up with that block in the middle with you that I talked about. And then the gross up of your payroll costs is either whatever the new amount is. If it's 60%, then you're going to have a different denominator. And the result is you'll have those 3 items, and you take the lowest of those and subtract your $10,000 grant if you got it, and that's your loan forgiveness amount. Now, all of that, I made a little example. It's at the end here, which we won't go through. but I've got spreadsheets in there and kind of illustrate how you would do it. That begins, I guess about slide 56. And I guess the point here is, I did this with taking the various parts of the instruction and doing a separate spreadsheet for each calculation to come down to these three numbers. Well, one doesn't really require a calculation, the loan amount, but a calculation basically of this salary reduction amount and the full-time employee headcount, and then put them together and final schedule at the end here, which is go to slide, I think it's slide 69. If you can go there, and then compare these three numbers. If you have a more complex case, what I've seen done on some of these Excel platforms that you can pull off the internet, is they have one accounting firm has all of the employee information on one big spreadsheet that obviously won't go on the screen, but has these columns that keep wrapping around. And then they pull the information off onto spreadsheets similar to what I have. Others, the AICPA has kind of these multiple spreadsheets, and the AICPA has their own kind of calculator, if you will. It does help if you understand where the numbers come from, just to check out that what's reasonable is coming out of your these calculators if you use them instead of doing it yourself, so to speak, as I've done in this case study. Okay, with that, I'll stop. So I guess, Stephen, you're next.
Yeah, Stephen, you had discussed proposed legislation, and there are some other business considerations. And thank you, Bill.
Sure.
I do have a comment. If we could go back to my slides, please. So we did have the Flexibility Act passed. I want to mention two to keep your eye on. One is the next CARES Act. We had CARES Act 1. Now we're talking about CARES Act 2, or what some refer to as Phase 4 of CARES Act 1. The House has weighed already. It passed the HEROES Act, and that was that $3 trillion bill. A lot of objections to it on the grounds that it was really just a Christmas tree, and so the Republican controlled Senate has not taken it up yet, but multiple discussions going on. It is expected there will be a new law sometime July, probably. Now, that new law may look back and affect some of the things we've been talking about today, because there are some additional cleanups that need to be made. And it also raises the question of when you apply for your forgiveness. At some of the Q&A, I think I saw a couple of questions on that. I mean, if you've already qualified for it, maybe you want to go ahead and apply now and see if you get your forgiveness. On the other hand, if you haven't, you may want to take advantage of what's now been passed in the Flexibility Act, or even wait longer to see what happens. But it cuts both ways. There may be changes that are not favorable. So, to be determined. Finally, there's something called the Truth Act. The Truth Act was introduced in the House, but did not pass at the time of the passage of the Flexibility Act. The Truth Act would require the names of the disclosure of names of all recipients of loans. So that would be a requirement of the lending institutions or borrowers who've received loans. One might see how that information could be used if, as Michael may mention to us later, we start to see a lot of enforcement actions occurring, and just generally provide to the public an understanding of who received the money. But right now there's a lot of opposition to that, especially among the Republicans, and it did not pass. If we could go to the next slide, please. I just want to talk for a minute about the application from a business lawyer's point of view. You will see, of course, as Bill explained to us, there are four particular forms. Now, when the borrower fills out these forms, 1 and 2 go back to the lender. So the calculation form that we've just gone through the process of determining how to fill it in goes back with your lender. In a moment, we'll see the lender has independent obligations with respect to it. But what I want to point out is that the certification on what's done is filled with the warning up front that if you're not telling the truth, here's the trouble you're going to be in. Whether it's inadvertent or not, of course, always has to be considered. And from a business lawyer's perspective, there is the word material, and one can go on forever about whether something is material or not. Right now, I don't see any examples that have been provided as to what would be a material mistake, but it's there. One more slide, please. Next one. Again, from the business lawyer's point of view, look who signs it. Well, it's not required to be an entity, a corporation, an officer, or a limited liability company, a manager. It's simply signed by an authorized representative, now, whomever that might be, and assuming proper authorization by the entity. Doesn't take me to tell those who are listening that are not business owners, lawyers, accountants, don't be a pal and serve as the authorized representative. Next slide, please. Now, the lender has some obligations. As we saw a moment ago, the borrower must submit items 1 and 2 to the lender. Let's jump down to the last 3 bullet points. So what is the lender's obligation? Well, the lender may not have to go out and independently verify because there will be some type of attestation form that the borrower has told the lender and has provided it with the appropriate documentation that supports the request. If it is determined by the SBA later that it was not proper to have granted the loan in the first place, then the processing fee for the loan is lost to the bank. That's a 5% fee, typically. So that's a reasonable amount of money. If that were to occur, the loan may stay in place, the SBA will guarantee the loan, and while the lender has lost the fee, it may still collect what will be modest interest on the loan. And of course, it's now faced with the possibility of action by the borrower against the lender who was given incorrect information during the process that led to the SBA's determination. Next slide, please. Now, jumping back to the original loans that were made, again, buried in there was a certification, an initial certification that was made by the borrower to the lender to qualify for the loan. Here's a couple of things that was, an odd thing that was in there. There was a representation that child support had been paid. So you were not behind on your child support, and that you were current on your taxes, that you'd met all environmental requirements, and that you had a 50% ownership or voting interest in the entity. That's a little typographical error that it appears in parentheses after child support. I point this out because these are the type of things that might be gone back to and investigated to see if it was proper to apply for the loan in the first place, and the child support one, while maybe not particularly of concern to most people, is lurking in there. Finally, in that original certification to the lender, the business lawyer sees that the borrower has undertaken not to make any distributions of assets that will adversely affect the financial condition of the borrower. What do those words mean? To be determined, although we've seen cases on it before. And finally, ownership change. You can't change your ownership structure or an interest in the business during the term of this particular SBA loan. Now, what's the problem with that? Well, capital's short, and even though this program was fantastic in providing some capital to businesses, their operating capital and their income, I mean, it's all at risk. So how does one go out and raise capital if you can't continue? Well, you can't, maybe, so you sell your business. To be determined what this consent meant and how waivers of it will be obtained, although presumably the banks will be happy to waive to a stronger borrower. Next slide, please. Let's take a moment and not forget our original loan documents. Again, what I had to look at: a promissory note, a business loan agreement, the disbursement request, the corporate resolution to borrow, and the borrower's certification that we just mentioned. Next slide, please. A quick mention to you that in the business loan agreement, it will continue to govern the relationship between the parties if there's only partial forgiveness or if there's no forgiveness, because we will then transform, we'll continue into the loan that has been entered into with the current 2-year repayment period, the 1% interest rate. And so I've had to take a look at all of the reps and warranties that they've made, their covenants, both affirmative and negative, and tell to my clients, be alert to the fact that you have a lot of obligations built into this loan. They may be no different than other loans, but nevertheless, they are in this loan. And finally, your bank, your lending institution, has a right of set-off. So if you are in default on this loan, of course, any account that they have in that bank is subject to being taken. Next slide, please. In the promissory note, there is this following provision, and basically what it says is that if new guidance, rules, or regulations, some of the things we've been talking about, are implemented, then the note is automatically amended to include those provisions as to loan debt forgiveness. Right now, those may be very beneficial. It's conceivable that after some period of time, when people see what has happened with these loans and whether they in fact have been treated properly by the borrowers, the rules, regulations, and guidance change in a manner that is more difficult for the borrower. Just pointing it out to you, the kind of thing I have to take a look at it. Perhaps not as much fun as Bill's worksheet calculation, but nevertheless, that's my version of what I have to do. Next slide, please. Finally, I want to just mention something to you. In that corporate resolution to borrow, there is a certification that was made by all borrowers to the lender that, in fact, this particular resolution had been adopted, and it's set out in the corporate resolution to borrow certificate. It's lengthy, but it's the type of thing you would expect. I would suggest that it is important to go back and do two things. One, make sure it's actually been adopted. Presumably you can't go back and have a meeting, but you can have an action by written consent or the equivalent in a corporation or a limited liability company, because that is an examination issue for later. When someone comes in and looks, you may see the certification, but you don't see the actual underlying resolution. Most importantly, as to this, I would say make absolutely certain that the officer who signed the initial borrowing documents and who may sign the subsequent certification has in fact been elected to that office or appointed. Sorry for the grammatical error there, my punctuation. But again, you don't want someone signing the documents that doesn't have the authority to have done that. That's just a cleanup item, but I would say an important one. Next slide, please. I'm going to pick this up a little later at the very end of the program.
So thank you, Steve. Thank you, Stephen. Bill, I've got a couple minutes for disbursements, bookkeeping, and record keeping comments, just a couple, so I can
Sure.
move it happen.
Thank you, Bob.
Thank you.
Just a comment on Stephen's presentation. I've listened to quite a few of these PPP webinars. I've never heard the particular information that Stephen just went through. I see a lot about how to compute these numbers, which I like, but I'm a lawyer. But these other items that Steve talked about, I think are quite important. People are just signing off, saying the numbers are, I get the loan and so on, and not really looking at what they're signing, I don't think, or at least looking behind what they're signing. In terms of this little topic I have here, which there's not slides for, I'll just briefly talk it through. We're talking about, I call the accounting documentation, the bookkeeping, and the record retention. And loan for my own firm, the bank had a list of the documents they required to verify how much loan, but the loan amount that I was requesting. And they also had certain underwriting documents, which, the resolutions and you're in good standing and financial statements, et cetera, that were listed in the materials that I got from my bank. And then when you go to the loan forgiveness side of it, my lender had its own list, and so banks typically do that. The statute itself, by the way, in 1106E, has a list of required documentation. They're talking about canceled checks, payment receipts, transcripts of accounts, and other documents to verify the amounts that are on these various forms. And then there's a statement in the statute that says, no eligible recipient shall receive forgiveness without submitting to the lender servicing the covered loan the documents required under this particular section. So presumably lenders will be looking for that, and so you should be ready for that. There are a number of documents that come from the calculations I have in my piece that I talked about. Retention, in the instructions, the instructions are the borrower must maintain all documentation in its files for 6 years after the time the loan is forgiven or repaid in full, the later of. So if you have excess funds and you're taking 2 years or 10 years or whatever it is, or 5 years to repay it, your 6 years is not beginning to run until your loan's gone. And also you're allowing an authorized representative of the SBA, including somebody in their inspector general office, to request and have access to these files that you're required to keep. The last point, which comes up frequently, is how do you keep track of your expenditures to show that you actually took your loan amount and ended up spending it on the particular eligible costs. And there seem to be two methods people talk about. So one's a two bank account. That is when you got the loan, you set up your own bank account. And then my question is always, well, then what do you spend for that out of that? If you have to spend 75% or 60% of your costs on payroll, it's kind of awkward to have a new account that's funding your payroll, but not funding your payroll for people making more than 100,000. So then you end up having your payroll being pulled from your general account, and then you reimburse your general account out of your special account for your loan proceeds. And we don't have time to go through the journal entry for that. The other method, which I think is easier, and people by default may be there already, you just put it in your general account, but then set up a ledger account that equals the amount of your loan, whatever that was. And then as it's spent or you close the books, whenever you're doing this, you're taking charges specifically from this special account, which isn't, because money's fungible, it's not really holding any money, it just has a balance. And you're just charging or crediting that account as you're making expenditures and making sure that the credits match up with eligible expenses. I think that's easier. I've done it with old-fashioned journal entries that I've given my accountant to do. But that seems to be an easier way to do it. And some people may already have gone past the period where they don't have a separate account. And my bank didn't want to go through the trouble of setting up yet another bank account after they were barely able to get through the loan process. And they were lucky even to get in as early as we did. So anyway, think about how you're accounting for the particular, or doing the bookkeeping for the expenses that are being incurred. But you do have to prove at some point, or may have to prove at some point, either to your lender to get the forgiveness, to get the approval, or if there's a review, which you can still have even if you're under 2 million. You can't have a review on whether you have a necessity for the loan, but you still can have a review of whether your loan amount was correct and whether you actually spent the eligible costs from the account balance. Okay, so it represents your original balance.
Well, you know, Bill, that's a good point when you mentioned review. And actually, do you think now's a time when Michael should actually address those issues of audits and enforcement reviews and all of that?
Absolutely.
Appropriate, yes.
All right.
Thank you, Levon. Bill, those were some great comments. I just know there's, early on when the funds were running out fast, some lenders didn't want to lend to people that weren't existing customers. And if you weren't an existing customer, you couldn't go to that bank. There's been a question asked, I can't go to my existing bank. Where do I go now? Through reading and literature, there's something called Cabbage, which is a micro lender or a smaller lender, KAB, and Cabbage. But in any event, there's still ability to get the funds now. I've been asked, and it's within sort of what I do for a living, to talk about audit and enforcement for the next 10 minutes or so, and some of the criminal cases that have already happened, surprisingly, have taken place. One of the first issues that we dealt with on enforcement and consideration is the certifying as to need. And over the past few weeks and months, there was significant concern that the PPP loans have been made to entities that not truly need the funds to sustain their business. There was a lot of media attention early on, announcements by the Secretary of Treasury about, hey, there are certain businesses who do not need it, who have applied, who got it. And there was a second look, and actually a frequently asked question added, and a safe harbor that I'll spend a few minutes on, because I think it ties in nicely to the enforcement process. This new frequently asked question 46, not so new anymore, last couple weeks, but in this world, we're talking a few months, so everything's relatively new. The exposure for getting that wrong could be financial penalties. We don't really know what those are yet, or criminal sanctions. We've seen those, but more importantly, significant public relations problems. And so on May 13th, the SBA issued an additional frequently asked question. We call it sort of the safe harbor rule with respect to need. There's a reasonable middle ground approach. And this reasonable middle ground approach, given to the uncertainty as to what's need. In my estimation, we're going through, and everyone on this, out there, we're going through a terrible time. And need is a very subjective term. And so what the frequently asked question did is it bifurcated into two separate categories. If you have a loan of $2 million or less, then you fall into one category. If you've taken a loan, your borrower with $2 million or more, you have another category. And I'll ask that the presenter put my slides on the screen so when I get to them, we can move forward. But for loans under $2 million, any borrower with a PPP loan that's less than $2 million is now deemed to have the need necessity. So these organizations are deemed to meet the need safe harbor. That's important. That provides the need safe harbor comfort for these borrowers to retain and rehire employees. It's important that it only relates to the need aspect. It doesn't relate to the other representations. What about loans in greater than $2 million? Well, organizations that do not satisfy the safe harbor will have to have an adequate basis for making the determination as to need, requires good faith. The SBA says that they're going to look at all loans in excess of $2 million to you could leave it right there, that's okay. Excess of $2 million to, one slide back, in excess of $2 million in order to, we'll look at every application And it ties in back to the loan forgiveness application where there's a box that was checked. Is this greater than $2 million? It's the SBA's way of keeping tabs on that. And so the good news is that for smaller, less than $2 million is a safe harbor. The news for greater than $2 million is that they're going to be scrutinizing those loans. I think there's going to be some level of comfort from the FAQ, which also says if the borrower repays the loan after receiving notification from the SBA will not pursue administrative enforcement or referrals to other agencies. I think that's only specifically relating to the need element, not other elements. And so I wanted to bring your attention to the FAQ on need. In addition, the interim guideline that came out last week, May 23rd, week and a half ago, deals with other issues. And if you go to a slide previous to this, please. Yes, so appeals of SBA actions. And so that's really what I'm talking about now. The SBA will review loans. They say they're going to review all size loans, not just large ones. They made it clear that it can and will review the applications. And what they review? Well, they will review, were you eligible for the PPP loan? Were the loan amounts and use of the proceeds within the realm of what Bill was talking about? And are you entitled to loan forgiveness and the amount claimed on your loan forgiveness? And it's going to be a difficult road ahead for the SBA because there's a lot of these cases, so they're going to have to pick and choose. But you're going to get an opportunity to respond. So the SBA might pick up a loan, and they've done it. And what happens when that happens? Well, if the bank rejects your loan and seeks immediate repayment, the new interim guideline says there's going to be an appeal process, and that's good. It says you're going to have 30 days from the denial notice to file an appeal. That's very good. Who's going to review that appeal and what's the appeal going to look like? That's yet to be determined. The SBA says they're going to issue further guidance. I think it's going to be similar in scope to what we see in our tax practices. When you appeal something, you're going to have to show documentation. You're going to have to deal with some legal issues. So it might create an industry, sub-industry in this area to consider. And the timeline of that is that they have 30 days. What do the banks have to do? The banks is when you submit that loan application, the loan application decision must be done within 60 days of when you finalize your forgiveness application. So there's now some change in timing as to when that forgiveness application needs to go in, but the banks still seem to need to act within 60 days, and they can prove it in full, they can approve it in part, and deny it in part, and there's going to be some remedies for the public, yet to be determined what those will be. I want to go to the next slide because I wanted to sort of ratchet it up a little bit. The government is serious about its warning of stepped up scrutiny of borrowers seeking PPP loans. And in May, within a span of 9 days, the DOJ, Department of Justice, announced 4 separate cases against defendants accused of committing fraud related to PPP loans. On this screen is the first one on May 5th. And look how fast they acted. Normally, criminal investigation takes years. But this is like as it was happening, they were there. And in this case, files were charged in Rhode Island against 2 businessmen in 2 separate cases, seeking more than $500,000 in a loan. The 2 men conspired, allegedly, claiming to have dozens of employees at different businesses when in fact they had none. And so on the screen, there's allegations of fraud. Their crested loans were smaller, $150,000, but in the aggregate about $500,000. The investigation was conducted by large multi-agency teams, which means that they had different government agencies involved. They issued a search warrant for Gmail records. They had an undercover officer or agent correcting statements from the person. And it appears that it may have arisen from a confidential informant or a whistleblower. Not on the screen, but on May 12th, There was charges filed in Texas against someone who had a $10 million loan. The man alleged to have 250 employees. He allegedly had none. On May 13th, there's an interesting case where there's a TV personality, a reality TV personality. He collected, tried to collect a $2 million loan, which he did, and he used $1.5 million of it allegedly to purchase expensive jewelry, a Rolex watch, a 6-carat ring, child support, which was one of the things that Steve mentioned as a non-eligible if you're not current on your child support. And there's been about 7 cases, total criminal cases, a $20 million scheme in New York, software engineer in Washington, $1.5 million, which was tipped off by the bank, and a Hollywood producer allegedly who used the money for personal use. So what's the takeaways? Well, these cases are examples of egregious conduct. I don't think this is the norm. It could be, but it's not the norm. They represent extreme, blatant, and intentional violations of PPP, and the government acted fast. It was important for them to do so, and they made the point. But you see the point that the PPP loan fraud can be swiftly detected. You see the point that fraud is the type, PPP fraud is the type that the government's interested in, and they're looking not only for representations, but for where the funds went. Different levels of law enforcement are involved, and banks are now part of the lookout for fraud as well. So the question really remains, how will criminal and civil enforcement activity or authorities handle closer calls? We see that with the frequently asked question or the interim guidelines and the questions in there, that they're gonna have the ability to look at certain things, and they will look at certain things. For closer cases, maybe it's not a criminal case, but they'll give it a civil touch. How long can the government do it? Interesting question. The interim final regulations state the borrowers must maintain records for 6 years. So they'll be looking at this stuff, through 2026, 27. However, there are criminal statutes that range for 5 to 10 years. And so this thing can be going on a long time. The point that Steve made about verifying from the business perspective is important. I think what Bill is saying was important in terms of getting the numbers correctly. And we think that the procedures in place on that will come that will explain how the audits are going to handle. I want to move the slide to tax treatment because that's the next segment before I turn it back over to the next person. Loan forgiveness and deductibility of expenses. So loan forgiveness is not going to be considered income for federal purposes because it's been written into the statute that way. That's the good news. The bad news is that deductibility of the proceeds used from the loan is not going to happen. And so if you look at the next slide, which is IRS Notice 2020-32, the IRS has already issued a notice concluding that no deduction will be allowed for expenses that were otherwise deductible if those loan proceeds are forgiven. Now the Senator, Grassley and Wyden and maybe others have written letters to the Treasury and saying, well, how could that be? The whole purpose here was we're trying to help people. And now you're making it essentially taxable or not as helpful as it could be. And they think it goes against the legislative intent of the CARES Act. However, I don't think that's going to cut it. There needs to be a legislative change. If I'm not mistaken, it wasn't in this last act, so that didn't change. The point here to make is, one, that the loan is not really 100% anymore. Now it's only 60% if you factor in the non-deductible, if you're factoring state taxes. And it also, one other thing, bringing into focus, now that we're in an extended period, we're no longer 8 weeks, we're 24 weeks, and we may have 10 months to submit a forgiveness application. You might be spanning over a different tax cycle. You might be looking at 2021 as to forgiveness, but the expenses occurred in 2020. So if we didn't have enough stuff going on in terms of this calculation, you're going to keep track of what was deductible in 20 because it wasn't forgiven, and then it was forgiven in 21, but now the part that you deducted needs to be brought back into income. So that's going to create some headaches. And one additional headache, California. You know, Beverly Hills Bar, great that everyone showed up. We live in California. California has conformity rules. And so the IRS is currently analyzing the impact of the CARES Act on California taxpayers. And the preliminary information that we see on their website and from who we've spoken to has indicated that they're not going to conform to parts of the CARES Act. Some they do. So the pension-related items such as early withdrawal penalties, they're not going to apply that. Minimum distribution rules in the CARES Act, they're going to allow for that and not change. But with respect to loan forgiveness is going to be taxable as it currently stands in California. So once again, you're going to have, for federal purposes, non-taxable but non-deductible. For state of California purposes, you're going to have includable in income for forgiveness but deductible. So, you know, it creates a little bit of a headache administratively. I think that you're going to see a lot of administrative cases in the PPP loan area. We're talking $600 billion of loans, that much of which should be forgiven. Some of that will not. You saw the 5% fee on $600 billion is a big nut to the banks and lenders. And then there's going to be an issue as to, is this a good loan but not forgivable? Therefore, it still is out there and you're allowed to borrow it for the 5 years or the 2 years or 1%? Or is this a loan that should not have taken place? Therefore, you got to pay it back immediately. And if you don't pay it back immediately, we're going to refer you somewhere else to have problems. And with that, I know we're getting a little nervous and short on time. I'm going to turn it back to LaVon to direct where she wants to go with that.
Well, and thank you, Michael. And so to address to close us out before some Q&A, for some additional thorny issues, I think that Stephen had some comments, and then we'll take some questions after that. Stephen.
I go back to my slides and I will sprint. If anyone's interested, they can go back and take a look at them. One thing I might mention on legislation is we maybe I'll be back here one more time, because while the PPP loans were fantastically successful, there's a whole $500 billion authority given in the CARES Act to the Treasury to make what are called the Main Street loans. And virtually nothing has happened with those so far. The Treasury is having a lot of difficulty in formulating the terms and conditions of those loans. So there's another $500 million that may eventually get poured out into the economy to handle the issues involving larger businesses. Quickly, if your loan is forgiven, it's not necessarily forgotten, and you can see a few examples in here, but I expect any company that got one of these and then goes through either a financing, sale, or acquisition transaction is going to have a lot of due diligence being done that will focus on this area, because depending on the size of the transaction, this loan could have been a significant item. And as Michael has just told us, the exposure on these loans continues for a long period of time. Next slide, please. Now, loan not forgiven, this loan won't be forgotten, and now we have to deal with issues of whether it's transferable in an acquisition transaction, and whether you can make any change of control transactions with your own company in terms of internal management, because you've got that borrower's certificate from the original loan that you got, in which you promised not to make any change of control transactions without the consent of the lender. Next slide, please. I just say finally that there will be lawsuits coming along, not just in the enforcement area, but in other areas. Next slide, please. And finally, just let me say that this is an opportunity, one that business lawyers rarely get, to actually make your client pay attention and do the thing that they hate the most to do, which is some accurate corporate and entity authorizations, record keeping, we'll use the word minutes, and all of this is an opportunity to get that done, sort of under the guise of making sure that you anticipate future due diligence and audits, that you want to qualify for your forgiveness, and you've got an opportunity to clean up the entity's records books. As in many other things we're dealing with today in our lives, I think the word from the business lawyer is be prepared and stay safe. Thank you.
Thank you, Steve. That's excellent closing words and greatly appreciated. We are going to go a few minutes over specifically so we can do some Q&A. I really appreciate our speakers, and we have a lot of questions. We've addressed, the speakers addressed some in the discussion. We'll take a few now, and then I know there's going to be a number of unanswered questions, and I hope you have our speakers' contact information. I hope that you will feel comfortable reaching out. So a straightforward question to Michael or Bill is that, what if you owe tax? Do you still get to make use of this program? That's one of the questions here.
Interesting. So if you owe any federal tax liability, is there a linkage? I haven't seen that in the interim guidelines or any of the other aspects. Steve talked about the behind in child support payments. So I think it would be more apparent to us at this point, but that's my thinking on that.
Michael, I'll quickly add that in the original loan agreements and notes, the representations and warranties on which the loan was conditioned had a provision that all taxes were current and had been paid.
So is that the business entity applying for the loan?
Correct.
Okay, good.
What about, so that's interesting, but it'll be up to the bank, I guess, to confirm that on the front end, I take it. So is there a possibility this becomes an issue on the back end if someone does owe taxes and somehow got through?
It does.
I think so.
Yeah.
What about lease payments, home office deduction, things like that? Do they get included?
That's interesting because I saw that and I had that question in another panel that I was doing. So I think your expenses need to be on a Schedule C if you're talking about a sole proprietor. So to the extent that it relates to a business aspect under what the Solomon test, potentially, but when you look at the statute, it talks about mortgages, which is secured by property, and it has a specific link as to in place on February 15th. So I think you run into difficulty if it's not a Schedule C item initially, and it's a little unclear in my mind what the specific answer to that is no, but I know you have to tail it to the language. We talked about mortgage existing. It's either on personal property for you or mortgage on real estate.
I think I saw a friendly feline for a quick minute, huh?
He and I talked about it before the program, and apparently he's chosen to act otherwise.
Well, we appreciate it. What about, I think I had a question here regarding there's a number of businesses to stay afloat. They had some outstanding expenses to which they may have, or can they apply any of these funds to liabilities that existed before the covered period?
So I know Bill covered that, but the phrases that come to mind is incurred or unpaid. So paid during the period or incurred during the period. So if you pay it during the 8 weeks, 24 weeks, it allows from some prior expenses to be paid during that period, or incurred as long as it's paid within the next billing cycle. Bill may have some more specific stuff since he spent a great deal of time examining it.
You think somebody asked a question about where they were behind on their rent, I guess, for obvious reasons, I think, and then they did a catch-up payment, but I assume it's after they missed several rental payments and they did a catch-up payment. So one would think, let's say there was, I don't know, it would be monthly, so it'd be only 2 months. I'm not quite sure how they did it, but if they missed the first 4 weeks, then they try to accrue it, then they missed the second 4 weeks, but they didn't pay anything, then I think they'd lose the accrual for the first 4 weeks, and they still have a chance for the next 4 weeks if they pay that by the next month, assuming they have monthly payments. And I'm assuming it's calendar months here to make it easy. So you could have a situation if you're behind on your lease payments or your rental payments, that you would not be able to use this accrual rule because you would not have paid it by the next billing date.
Correct.
So somebody did ask that question. I think it's a fairly important one. I haven't seen it that often, but I have seen it.
But Bill, if you paid it during the 8-week period or 24-week period, even if accrued before the loan initiation date, how would that be treated?
Yeah, well, the accrual rule seems to be a different. You have to accrue it or pay it in the covered period, whatever that is.
Right.
And then if it's something that you're going to accrue but not pay it, then you have to pay it by the next billing date. I mean, that's what it says.
Right.
I have a question here. Any thoughts on whether the yet unpaid 401k payments to employees are includable employment expenses to be forgiven?
Yeah, I think the 401k payments would be. There is this question about whether you have to accrue them because it's presumably for even the prior year, I guess, depending on what your plan provides. But it's saying paid or accrued, so it seems like you could double up in that period where you pay it. So if you pay it in the covered period, it should count under a strict reading of the rules. It would seem more reasonable that you shouldn't be able to pay something that's earned in a prior period, but you can do it with wages, so why not with 401k? It just happens to be a longer period. Wages, when you accrue something and then pay it, it's over a month period. But when you take a 401k, it's probably for the whole prior 12 months or more. But I haven't seen a rule that addresses that situation. It seems like you could pile up a little bit on your payroll costs.
Yeah.
Using that mechanism.
I would agree, but I think you have to also be cognizant of the 852 rule, which if you're looking at payroll, the payroll limitation per person before you're talking about the new enactment is about $15,000. So I query whether there's some 852 rule with respect to 401k contributions for the prior period. I don't know, but at the end of the day, you're still, in fact, limited by either the 8/52, or we really haven't talked about it, the 24/52 rule that might be coming.
Now, questions I've heard out there are, do they need to be the same employees when you're doing the calculation?
No. No. I mean, you got several calculations. You've got the full-time equivalent employees because of head count, and that doesn't have to be the same employees. If you're talking about rehiring, it sounds like it should be the same employee, but I think what they're saying is just restore your full-time employee equivalent. It doesn't make any difference if you rehired or hired somebody that is not somebody who was let go, but I have to look at that more closely.
And
for the other one, the salary reduction,
exactly.
that seems it's employee by employee. So you can't really mix, you can't reduce somebody and give somebody else a raise, so to speak, I guess. Although when it comes out as to the total, it only comes out as reductions. So if you reduce somebody and raise somebody, the reduction is going to count if it's more than 25%. It's not employee by employee. But raising somebody else to keep the total payroll the same won't work because it's only reductions that count. Okay. And also people over 100,000 aren't even in the salary reduction calculation. I'm not sure the specific question they're trying to work on, but if there's full-time employees, then it doesn't matter it's employee headcount in the reference period and then in the covered period, whatever that is.
Now, Michael, you had mentioned a look-back period, or rather a kind of certain statute of limitations. And Steve, I think you had mentioned periods as well. Is that right? Or because so it's at least, I think we're talking about at least 5 or 6 years to hold the documents, 6 years exposure. How long would you recommend that people hold on to their documentation again for all purposes?
For all purposes. Well, for this purpose, the rule says 6 years. I would always probably tack on another year on top of that just to be safe. There are other statutes that can apply. In the criminal realm, it's 5 to 10 years, depending on which statute. But probably 7 years is a probably good rule of thumb. It's shocking that, now we have things electronically. So when they talk about hold your paperwork, are you really holding something electronically? It's doubtful that people are going to hold the actual physical copies. And maybe there was never any physical copies of the loan application or any of that stuff at this point.
Stephen, any final
I
thoughts?
would think I'm sorry. I think you could scan.
Yep.
Or just move over into a file. And that's what I would do. I would recommend having a separate electronic file of whatever the accounting records or bookkeeping records are, move those over, for whatever the covered period is, to support your calculations. Anything else that's on paper, like it's on the applications, I think it's scanned and put into your electronic files. If you have a lot of them, if you have 300 employees or up to 500 employees, it's going to be a little cumbersome to have physical paperwork for everyone. You could, but
That's a good point. Any final thoughts, Stephen?
No, I think that covered the point. I think it's an opportunity to say now to your client, borrower, if that is the case, do it now. You'll never be able to reconstruct it later. Do it now. If it's physical paper, scan it and put it somewhere electronically, as they do, hopefully, back up that electronic file and just make sure you have it. Because otherwise, as Michael said, we're going to have a lot of audits over $2 million. We may see them in under $2 million. Who knows what might happen there? But although right now it seems like it's, at least with one respect on the need test, it's clear.
And just one point on that: if 80% of the loans are under 100,000, 20% are over 100,000. And if they've earmarked $2 million or greater, that allows them to use less resources. But that's still a lot of files out there. And we don't know what to extent and how aggressive they're going to be. But we assume, if they stick to their word, that they have the ability to look at small ones, large ones. The lenders are going to be the gatekeepers to a large extent on the loan forgiveness application. But they do have the ability to do it. And maintaining the records to support your case is going to be an important part of that.
they might do an issue-specific kind of audit for the smaller loans, just whatever they think. If they found that there's certain parts of this procedure that people are not properly documented in some way, maybe just do an issue-specific and not ask, do a complete audit of all these records you're supposed to keep, but just particular numbers, whatever they happen to be, whether it's the payroll. Like, we don't have no payroll. That was an easy one, I assume, but if people are claiming large payroll. If there's some other questions are answered on those applications, you can just audit those questions, would give them some idea whether there's something that's probably a stray in the application processes.
Well, I want to thank everyone involved in this process. So a thank you to our audience that hung in with us. We're at 4:47. I know that there were a number of questions in Q&A and chat. We got to some of them. We did not get to all. But you do have the contact information and also the materials. A lot of the materials that I think answer some of the questions. And unfortunately, we didn't get to all of it, but there's a lot there and it is available to you. I want to thank certainly our speakers. Thank you, Bill. Thank you, Stephen. Thank you, Michael, for this presentation. Thank you to Alex over the BHBA, who's helped us kind of get these materials in front of you during this presentation. At this, I guess I want to wish everyone a kind of close up. It's not for good, but for now. And wish everyone a wonderful rest of the day. Thank you for attending this program.
And thank you, Levon.
Welcome.